You don't live in the present economy. You live in the past one. Every chart you see, every headline you read, every confident expert on TV, they're all describing something that already happened. And the uncomfortable truth is this: by the time financial data reaches you, the real decision-making is already over. The market has moved. Capital has shifted. Risk has migrated somewhere else. You're watching the replay. That's why financial data always feels late. Not because you're slow, because the system is built that way. And once you see how this works, you can't unsee it. Right now, people feel confused. Inflation supposedly peaked months ago. Jobs numbers look strong. Markets rally on bad news. Crash predictions arrive after crashes. Feels like the economy is lying to you. But it isn't lying. It's lagging. And that lag is not a bug. It's the core feature. To understand why, we need to start with something simple. Economic data is not reality. It's a shadow of reality. Imagine trying to understand traffic by looking at yesterday's CCTV footage. That's basically what GDP reports do. Or inflation prints. Or employment numbers. They don't measure what's happening. They measure what already settled. Money moves first. Paperwork follows later. Always. Let's talk about how data is actually born. When you hear inflation rose 0.3% last month, it sounds precise, clean, scientific. But that number is stitched together from millions of messy human decisions. Prices collected manually. Surveys answered weeks late. Businesses revising figures quietly after the headline fades. By the time that number is finalized, debated, and broadcast, it's describing a world that no longer exists. And this delay compounds. Retail data lags consumption. Employment lags layoffs. GDP lags everything. Even real-time indicators aren't real-time. They're estimates of estimates. So why do markets react instantly? Because markets don't trade data. They trade expectations of future data. This is where the confusion begins. Let's slow this down. Markets are not thermometers. They're prediction engines. A stock doesn't move when earnings are reported. It moves when expectations shift. If bad news was expected, prices already adjusted weeks earlier. If good news disappoints expectations, prices fall even if the headline looks positive. That's why you'll see absurd moments. Unemployment rises. Markets rally. Inflation cools. Markets crash. It feels insane until you realize markets are reacting to the gap between expectations and reality, not reality itself. Now here's the uncomfortable part. Who sets those expectations? Not you. Expectations are shaped early, quietly, and upstream. By banks, funds, institutions with access to private flows, not public data. Credit card processors see spending before retail sales are released. Logistics firms see slowdowns before GDP notices. Banks see defaults before unemployment spikes. This is called informational asymmetry, and it's structural. By the time the public sees confirmation, insiders already repositioned. That's why financial data feels like an obituary, not a diagnosis. Tells you what died, not what's dying. Let's talk about revisions. This part is almost funny if it weren't so serious. Most economic data is revised. Quietly. Later. Initial GDP prints are guesses. Inflation baskets change. Employment numbers get rewritten months afterward. Sometimes entire recessions are officially recognized years after they happen. Think about that. You can live through a recession and only later be told it existed. So when policymakers say they're data-driven, what they mean is they're steering by the rearview mirror. And they know it. That's why central banks don't wait for confirmation. They act on forecasts, models, signals that never make headlines. The public hears, "We raised rates because inflation data was hot." The truth is closer to, "We raised rates because future inflation looked dangerous 6 months ago." By the time data confirms it, the damage is already done. This creates a strange emotional cycle. First comes denial, then confusion, then outrage, then acceptance, and finally revision. Let's make this personal. You feel poorer before inflation shows up in charts. Your expenses creep up quietly. Your savings feel thinner. But headlines still say inflation is transitory or under control. By the time the data agrees with your lived experience, your purchasing power is already gone. That's not incompetence. That's delay. And delay favors those who can move early. This is where power enters the story. Financial data doesn't just lag reality. It lags capital. Big money doesn't wait for confirmation. It moves on probabilities. If there's a 60% chance something breaks, that's enough. You, on the other hand, are told to wait. Wait for data. Wait for clarity. Wait for certainty. But certainty only appears after opportunity disappears. This is why financial media feels perpetually wrong. It isn't malicious. It's downstream. By the time a trend is safe enough to explain, it's already crowded, already priced, already fading. Think about every major event. Housing crash, inflation surge, tech bubble, bank failures. Warnings existed early, but they were dismissed because data hadn't confirmed them yet. And when confirmation finally arrived, it wasn't actionable. It was historical. Now here's the irony. The more data we collect, the more delayed understanding becomes. Why? Because more data creates more noise, more revisions, more narratives. The system becomes slower, not faster. And humans hate uncertainty, so we cling to numbers that feel solid, even when they're stale. A chart with clean lines feels safer than intuition, even when intuition is ahead. This is why financial education often fails people. It teaches you to read reports, not systems, to follow releases, not flows, to react, not anticipate. But anticipation doesn't come from numbers. It comes from understanding incentives. Ask better questions. Who benefits if this trend continues? Who is quietly exiting? Who needs this narrative to be believed? Data tells you what happened. Incentives tell you what's likely to happen next. And incentives move before spreadsheets update. This doesn't mean data is useless. It means data is context, not signal. It's a map of where the economy has been, not where it's going. The danger is mistaking confirmation for foresight. So when you feel like financial data is always late, trust that feeling. Because it is. Not accidentally, but structurally. The system rewards early movers, not careful readers. And the final uncomfortable thought is this. If financial data were truly real-time and perfectly accurate, markets wouldn't exist the way they do. Volatility comes from uncertainty. Profit comes from delay. So the lag stays, which leaves you with one question. If the numbers are always late, and the real game happens before headlines appear, what should you be paying attention to instead?